Right guys, welcome back to the channel. So this video is going to be all about calculating risk and how you go about calculating the correct lot size to place your trade. Right, so the way I go about this is very easy, it's very simple. So obviously when I'm getting into a trade, before I enter the trade, I know exactly where my stop loss is going to be. So I don't place my stop loss based on my risk. I place my stop loss based on a technical level or based on price action, right? So it's in a place that I think, right, if I go there, then I don't want to be involved with the trade. Right, so we use the Euro US dollar. So if we was in this trade here, okay, if we're looking at this setup, this descending channel, right? And as you can see, this descending channel has just formed at a previous level of structure, right? So we've got outside structure looking left with divergence on the RSI, and we want to get long at this level, right? Right, take a long position at this level with my stops below the low. For the sake of this example, we're going to shoot for a retest of the channel, right? So about a 2 to 1. So the same with any trade, right? I know where my stop loss is going to be and I know where my target is going to be before I enter the trade. So now I want to calculate how much I'm willing to risk on this trade so that my account isn't overexposed, right? So let's say that we've got a £10,000 account to keep the numbers nice and simple, right? 10 grand account, and I'm willing to risk 1% on this trade. Obviously, this is just an example. You risk whatever you're willing to risk based on your back testing and whatever your system allows you to risk, right? Alright, so how I calculate this is I use a website called Baby Pips. For the way that I calculate this, I use a position size calculator on Baby Pips. So this is very simple, very easy to use, right? So it's going to ask you for a few metrics that you've got to input. So your account currency. The account currency that we've got is Great British Pounds, right? Account balance, we said 10 grand. Okay, and we want to risk 1%. Then it's going to ask you for your stop loss in pips, right? So you've got to go back to your stop. You've got to measure your stop. You can do it on TradingView. You can use the risk reward ratio tool, or you can use the ruler tool there. So we've got 14 pips of risk, right? This grey area from our entry point to our stop loss is 14 pips. Currency pair, Euro US dollar. Now this last metric is where you've got to be careful, right? Because it's going to ask you for, it says current pound dollar ask price. Now just note, right, it says pound dollar. We're trading on the US dollar, on the euro dollar, but it wants to know the pound dollar. So generally this is going to be a cross between your account currency and either your main or a cross currency that you're trading with. And then it's either going to ask you for your ask or the bid, right? Your bid or your ask. Now, if you're using TradingView for analysis, right, the sell is going to be your bid and the buy is going to be your ask, okay? So pound dollar, okay, again, we got to make sure we're on the right currency pair. So if we go to pound USD, and we can see that the current ask price is 136.09. Calculate, and then it's going to give us some metrics, right, down the right hand side. Now, so our amount at risk is going to be £100, right? £100 out of our 10 grand account is 1%. Now, depending on your charting software or your, whatever you use to execute your trades, you're going to have to use one of these metrics. Now, TradingView, NinjaTrader, various other platforms are going to ask you for it in units, right? So if we want to input units, we'd input 97,200 units. If we need standard lots, which I know MT4, MT5, they ask you for standard lots, that's going to be 0.97 standard lots, right? And if your platform asks you for mini lots or micro lots, obviously you got them metrics there as well. So, and that is going to be our 1% risks. Right, so if we was to lose this trade, we'd lose £100, right? £100 of our 10 grand account, and this trade is a 2.09 to 1. So if this trade rallies up and hits targets, we would have gained £209, right? And obviously that pushed up and hit targets, so we're out of the trade for £209, right? One thing that people don't allow for and that you've got to take into consideration is if you've got multiple trades on at the same time and you've worked them all out based on your original account value. So let me show you what I mean, right? So let's say that we've got our 10 grand account, okay? and we have, and let's say that we trade, I don't know, 10 currency pairs, right? And we get a setup on all 10 currency pairs at the same time. So we work out our risk, a 1% risk based on our 10 grand account, and we have 10 trades on all at the same time. Alright, so if the first trade gets stopped out, right, then what you've got to understand is that all the trades following on from that are no longer going to be a 1% risk on your account. They're going to be greater because your account value is going to drop. Right, so let's say that this first trade was to lose, okay? Your account balance would now be at £9,900. However, our next trades, they're still running at the same lot size as before, okay? And we thought that it's 1% risk. However, this is no longer 1% risk on our account because obviously it hasn't allowed for the fact that this trade has lost. So now, instead of risking £99, right, which is what would be 1%, this is now risking £100. So instead of losing 1%, this is actually going to be more like a 1.1% loss, right? Which doesn't sound very significant, but obviously if you're entering multiple trades and you're not allowing for this fact, so by the time you get down to this trade and they've all lost and you've calculated this 1% based on your original account value, this could end up being something like 1.5% of your account, or you know, it may possibly even higher. I'm not actually sure on the maths, I haven't calculated that, but just as long as you understand that this doesn't allow for the fact that if you're placing multiple trades, you base them off of one account value. Do your own due diligence and you go through and do some calculations yourself and you're happy with your own risk, then you know, that's just one thing I bear in mind with using this method. So whatever you use, whether you use a fixed lot or you use a percentage based risk on your account, I just encourage you just to stay consistent with what you're using. Make sure, again, you're testing whatever you're planning on using and whatever you're using as a positive expectancy over the long run, right? So I hope you got value from this video. If you did, make sure you drop us a like, hit the subscribe button for more content like this, and if you want to see anything, make sure you drop me a message and I'll be sure to cover it. So wherever you are on your trading journey, I hope you have a good week and I'll see you on the next one.